At the close of an eventful year, the main external influences on emerging markets appeared to be Donald Trump's victory in the US election, the Federal Reserve's interest rate policy, and the ongoing strength in the US economy. But prior to that, we had seen volatility in Japan associated with its macroeconomic policies, India's shock election result, and the unleashing of stimulus measures in China. Through it all, we have also seen many emerging markets maintain good economic expansion and solid earnings growth, even though in some cases equity performance has been volatile and varied. With me to share his assessments of the past year and provide his outlook for the first quarter of 2025 and beyond is Matthew's Chief Investment Officer, Sean Taylor. What were some of the big performance drivers across emerging markets, both internally and externally?
Well, I think overall, the main theme was probably AI that drove Taiwan. That's also driven the US markets. And then from certain periods of the year, Ben, we had US rates and US interest rate expectations, plus the strength or weakness of the US dollar being a real driver. So, the beginning of the year, going into the middle of the year, it was all about when a rate's going to be cut. And then towards the last quarter, it's really been driven by rates up, expectations of rate cuts being less, and the US dollar being strong, and all to do with, as you say, the election and President-elect Trump coming in.
And in terms of some of the internal drivers, we've seen a little bit of a recovery in ASEAN through the year. As you say, Asia has outperformed Latin America. Can you comment briefly on that differentiation?
Yeah, let's take it as a regional basis. So we have these global factors that have driven, say, Taiwan, driven some of the rate markets. But then, on the ground, we've had China, which has been a very tricky market this year. It started off doing very badly, then it had a good pickup. Then the economic data didn't come through and it faded. And then we had a very good run when we had this sort of policy pivot in September then. And India started off incredibly well until the election. And after the election, it's been a bit trickier. Then ASEAN, as you said, it's just been a steady pickup, growth picking up. Some markets have been a bit, restrained because of the rate cycle. But it's had a positive performance in the year and then has faded a bit since the election. And then Latin America has been, really a major underperformer within that then. And that's really been because of the combination of US monetary policy and the US dollar, but also internal politics, particularly the election in Mexico and what I would call as shenanigans in Brazil have led to risk premium being a lot higher than would normally be.
Well, let's talk specifically about our markets, perhaps starting with India. How did its equity market perform over 2024?
So the market did incredibly well going into the election. And then when the election happened, there was a bit of volatility around it because Modi was expected to win a lot of by a big majority and then ended up having to have a coalition government.
Where have you seen the weakness in earnings? Have you seen it in specific sectors or small cap or large cap? And how have you been selective to manage that?
It's been fairly consistent across the board, but the main areas have been the consumer and also in the mid and small cap as well. So I think in mid and small, it's like expectations were too high and a bit more coming in slightly below, but the still absolute number, Ben, is good. But it's really been in areas like the consumer where the economic growth, and this is one of our things that we've talked about in the past, economic growth isn't getting through to the average person on the street. It's really about supply side change and not yet improved demand. And so we've been, very focused more on the financial area, large cap area, and companies that, have got consistent earnings growth and expectations weren't so high. And we remain positioned in that way at the moment.
Let's move to North Asia. What's your assessment of the performance of Taiwan and South Korea in 2024?
Well, it's been incredibly different. I mean, Taiwan up 32%, South Korea down 20%. What's been the main drivers of that? Well, Taiwan's been driven basically by AI. It's been in a very narrow, couple of stocks, and it's been the beneficiaries of what's been happening in Nvidia and the chips area, etc., and the supply chain around that. And actually, even though it's done incredibly well, we still like the sector because the earnings is there and there's visibility in earnings. So that is positive. Korea's been more difficult. Domestic demand's not been there really. And then we've had, more recently, we've had a bit of political instability there, which has also caused a dampener. Actually, throughout the year, we've managed to find some good opportunities for the funds, mainly in the value up trade, but it's very selective. It's not that every company has done well. Actually, we've found our better opportunities in the financials, whereas some companies like the autos have done incredibly badly because even though they have that value up tailwind, the headwind of what's been happening in global autos has been too much.
Now, and then there is, of course, the second biggest economy in the world, which is China. How has China performed in 2024?
Well, yeah, the way I look at it is you've got MSCI China, which is mainly stocks listed in Hong Kong or ADRs, some with the ability for local investors to buy through the Connect. And actually, these companies have done much better. They have, particularly the leading companies, have had much better earnings growth, but it's been driven by their own doing, as in revenue growth hasn't been that strong, but profit growth has. And so they've been cutting costs. They've been not subsidizing, going for market share at all costs. They've been going for more profitability. And then they've been very shrewd in capital management. They've been buying back shares. They've been increasing dividends. And so that's been very positive. Now, the question is, can that continue with the weaker economy? The second area is the A share, which is much more domestically driven. And, we sort of break it down into, a third related to the consumer, which has been quite weak. And that's been quite weak because wage growth is quite weak and labour support is quite weak. A third has been driven by the whole sort of property, and anything to do with property, and property's been very weak, which is why the government stepped in September to try and deal with some of the supply issues there. And the third area has been manufacturing, which has actually been okay, but it's coming off a very, very high base. So overall, the A share, the mainland onshore market, has been much weaker on an earnings basis than the offshore.
Now, as we turn to Japan, volatility has very much been among the watchwords, as well as changes in leadership. What's your view there? Is it entirely been the macro environment that's been driving sentiment and performance in Japan?
But it has been a little bit disappointing because the earnings have been coming through. But what's been hurting the PE has been two things. One has been the politics, which still continues to be quite difficult. And two has been the currency volatility. So in August, we had a huge fall in the Japanese equity market and led by the FX, as the government sort of tried to put rates up and didn't signal it that well. And I think that put off a lot of foreign investors. So, when we're looking at it from a company level, we can't see any change in the progress story that companies are continuing to reform. They're getting better earnings, but the market's not paying for it yet.
And how do you apply, our investment process? I know we look at specific growth, the idiosyncratic characteristics. We look at cyclical, what would you, how does that interface with the macro? Do you try and balance both?
Well, in Japan itself, it's really driven by earnings growth. We look for companies that have good earnings growth that are going to beat expectations, and that it isn't priced in. And when it's priced in, we will look for other opportunities. So the real focus is on those companies with better earnings. Some macro affects the valuations on that. It makes it cheaper. And sometimes the currency benefits those companies. If it's stronger, it might be a beneficiary, or if it's weaker, it might be a beneficiary. So it's very much down to individual companies and target prices.
Let's turn to a few other emerging markets, perhaps more on the periphery. You touched on Latin America. What are your thoughts on Mexico and Brazil this year in 2024?
Well, Mexico we've been very cautious on since the beginning of the year, partly because there's a presidential election. President Sheinbaum came in, the market sold off as we expected, and since then we've had challenges from both what the Trump administration how they will interact on the immigration side and the tariff side, and we've also got worries about local politics. So it's been a market that's been underperforming. And then on the Brazilian side, the growth's been there, but Brazil has had to put rates up for credibility in the central bank. There's been worries on the fiscal side that the Lula administration will spend more money than expected, and that's worrying people. And so that's been the real headwind there. The market is incredibly cheap compared to history.
Thank you. Let's turn to the outlook then for 2025. The main narrative could be the scale of the impact of the new Trump administration, not just on the global economy, but emerging market economies and markets. But balanced against that, of course, are the intrinsic dynamics of emerging markets and the growth that they're generating internally. What's your view on both aspects, Sean?
Yeah, I think it's going to be a tricky year for emerging markets in Asia, and certainly a tricky start. But I expect the playbook will be volatility at the beginning of the year, and then a pick up after that. And what does Trump mean for emerging markets or a Trump administration? It means potentially higher dollar, potentially higher US Treasury, potentially higher rates because of this inflationary view. It also means tariffs. On the first facts, we've probably got a stronger dollar likely outlook. On the other hand, a Trump administration seems to mean a stronger US economy. That's good for growth. That's good for risk assets. And we have the story of emerging markets still growing quite strongly from their domestic base or exporting into the US, depending on the level of tariffs. And so, we would expect high single-digit return for Asia and emerging markets next year, with most of it backloaded. If there is going to be a real tariff risk, it's going to be in the first month or two. There.
Do you think a lot of this is priced in? We already know what Trump has been suggesting in terms of tariffs. If he does impose those tariffs at 60% or 10% across the board, it's hard to speculate, but the market knows this, right? And there's a lot of, debate as to whether these are negotiating tactics as well.
60% tariffs will hurt China, but then it depends on the Chinese response. And, as we were saying earlier, we've got the sort of pivot in terms of the Chinese government wanting to sort out the economy or sort out some of the areas that are hindering economic growth, like the property overhang. And it really depends on their response to that. So, the market is probably 50-50 split in terms of Trump tariffs are definitely going to happen. It's going to be bad for China, or tariffs are going to happen, but it's going to be used as a negotiation tool and won't be as bad in the end. And then, how quickly does is it 60%? And how quickly do the Chinese respond?
It's going to be perhaps a tricky year. Really, it will call on our edge as active investors, active managers. And who knows? We don't know how long, the US will keep growing. We don't know where the bubbles may be, if there's exuberance, diversification there's always a need for diversification. And we may get, a real tailwind from China's stimulus. So, it could be tricky, but there could be some tailwinds and there could be some reasons for diversification. And I just wondered if you could comment to that, particularly as active investors going into 2025?
The outlook for EM over the next 3 to 5 years is very positive, and it's really driven by earnings growth, which is coming through in cheap valuations. And relative to the US, most people, when they're doing their multi-year sort of cross-asset forecasts, are showing that you can get a better return in EM and Asia over that period, because people are expecting a slowdown in US returns. The challenge is just we've got a few headwinds and unknowns going into the year. And by the first quarter, those will be over. We will know what the Trump administration will do on tariffs, and the market will reflect that. And also we will know what China's stimulus will happen and going into the 2 sessions. So, I do think that after the first quarter, there's a very good outlook for the next couple of years.